Can I start? Yeah. So welcome all. I'll talk a little bit about one of our fintech cases. So unfortunately, this is something picked by Linz for me, so I'll cover this element. The topic is essentially related to how can you predict earnings and loss in financial industries, and this is a use case we did for the US banks. And this is a little bit of agenda, but what I wanted to focus is a short about us. Who are we, what we are doing? We are a company specialized on the data analytics, but because we are specialized on the data analytics, we also wanted to build some of the tools and products, and this is also why we organized our company into two different verticals. Classical consulting, or our so-called profit part, and our loss part, or our development, where we try to develop as much as products we can to help us down the stream in some of our work. And what we also have is our research part, and one of the topics tomorrow you may see is from our research department, where we do a music splitting by using AI algorithms, etc., etc. Now, this project essentially came from the profit side of the business or our consulting line, and from the coverage mostly focuses on US based, and you see that even our projects are mostly focused on US until maybe last year. Now it started to shift more to the east. It looks like there is a saturation now on the west coast, and now we are moving a little bit towards the sun. So let's brief about us. I don't want to go more in depth. What and how we started. Everything started related to short-term loans for one of the banking in US. And I need immediately to put a note, this will be mostly a business-related talk. If somebody needs some technical details, we can cover it after this one. But I would like to focus it first from the business side, why we opted. And additional caveat, this is a heavily tuned for US market rather than European market because of some of the data biases and additional data sources available on the market. What we did saw is that existing loan models and risk scoring, etc., have a quite issue of predicting fast pacing changes on the market, and whatever it does from economical shift elements. So this is the reason why we went on a different approach, how to model all of it. And based on that one, how can we get a future forecast of revenue, loss, charge-offs, etc. for our banking industry, so that banks can plan their reserve or can plan or even operationally when to sell those bad debt and loans if they see them as a not viable or not profitable, etc., etc. Okay, this is also, this line of the business exists for quite a while. There are multiple approaches how to do something, but really our motivation at the end was a small one. So without this one, you can't go anywhere. But this is not just it's also a client. So you needed to focus on different elements, what and how you are getting a benefit of the project, because project needs to be profitable to go and end in the production. So what we started with approach which will focus on two different elements. It has a multiple different ML models in the background, but two main elements are related to any forecasting of revenue. Classical revenue forecasting can tend to use a time series analysis, etc., but in banking industry, this is quite tricky because at some specific point, when you come into defaulting behavior, regulatory obligation starts in and kicks in. It's something you can't model. So we focused on two elements. One is a defaulting prediction, when you are going into default, and then based on defaulting element, we start with a revenue prediction itself. And classical data science approach was started with a lot of work and then 10% of really modeling at the end. So preparation of the data, curating them, augmenting them, seeing what is missing, do you need to recalculate, add additional elements, and then last 10% is really the modeling part. So it is quite a data science type of approach. When we started with the two different data sets. Yes, they are enriched, but we defined a solution to be more like a service to the clients, which you can deploy, and they need to call it with two sets of information, and then they'll get results. One of the sets was related to physical data, the other one is related to metadata, which describes all of the information. Data itself, again, two sets of the data. One is a customer demographic and information wide as much as it's possible. Again, this is the reason why I said it's a heavily focused on US market, because US market has something called white lists. Europe and the whole region has something called blacklists. If you are not good payer or what, etc., you get on a blacklist, and then banking can exchange those information, and it can impact your ability to get the loan. From the other side, US also have a white list, which means that any transaction going into something which can be detected as a loan, even overdraft of your credit card, will get recorded, so you know completely the behavior of the client. It exists as a government service. It is paid, so you need to be careful when you are calling it. You don't want to call it for every loan you have in your portfolio, otherwise you'll pay more money on just reaching that service than providing and potentially earning through the loan itself. Banks always check this when they issue the first, or when you assess first time for a loan, they will get that data. So this is why we enrich it at that point, and then try to get a sense when defaulting behavior, when bankruptcy behavior will start happening, to see those high candidates which you need to reevaluate again. So this is the reason why we opted to extend it as much and try to limit additional calls and expense to third-party sources. And then we have a classical payment data set where all the payments you do on an already built loan get into system, and you start tracking trends of the payment behavior per industry, per person, etc., to get operational use of on a loan level, not on aggregated revenue level at the end. And again, metadata files, again, describing each of those customer and payment data sets, so that based on some abbreviation of the names, they can easily trace it and have some governance on top of it. So when we started with the project, we opted with a classical revenue forecasting method, and unfortunately that is not a correct way to do in the banking industry. So luckily we scrapped it after 2 weeks and started with a proper element which has a lot of additional work which is not an ML. So it has an expert system. Why? Because first of all, every loan has its own payment schedule. Payment schedule depends on what type of the products did you took, where did you took it, what is the industry amount, length of it. So it has a lot of, in which state, especially if we talk about US and all of the states, every state has a different government rules, how it's calculated. So this can't be modeled with ML. So it needs to be an expert system which creates a schedule instead of you. So it started with the creation of the payment schedule. So whenever you create a new loan, besides their original system, you create, again, the same payment schedule on our side, so that we can start tracking how they are doing a real payment versus what we have predicted that payment will be in the system. Besides payment schedule, we start layering the proper payments which happened, so that you see where there are discrepancies. And based on those two information, you can see some of the models, ML models a little bit later, which we will cover. And then based on this, we start to detect charge-offs. Charge-offs is essentially a point in time when you come into defaulting behavior. And when you come into defaulting behavior, again, based on the state level, sometimes you can go up to 90 days from the last payment, where you still count something as earned, even if you didn't get any payment, but this is how law regulates. This is why we needed expert system, not prediction system at all. And based on that charge-offs, you kick off a different process, which will recalculate how and what needs to be charged off, or essentially it's your loss. And is it high enough that you either sell that loan, or you try to add and ask additional information from third-party APIs to enrich it more and recalculate the value of those loans. Based on that, we started to go in a process what and how to get it from those two data sets to start modeling now. We have an expert system calculate payment schedules. We have an expert system calculating a charge-offs when you reach the point. So now we need to come to the point where we start modeling something to predict it, and then trigger off appropriate expert system on a specific point in time. So this focused us to build a little bit more models. We started with two types of models. You have a model which are not time dependent and models which are time dependent. Bankruptcy prediction started as a time independent model, which they are now using, or one of the clients is using it for their risk scoring before they give a loan. Because based on multiple different information from the customer demographics and type of the products, you can see a likelihood of bankruptcy of that specific customer before you give him a loan. Not when, but will he default at any point? Because this will now be good enough information that you can have it in your risk scoring. If you are getting 10,000 USDs as a loan, you have tendency to be bankrupt. How much will be in a risk to give you a loan and potentially sell it down the line to, again, other banks who are buying loan and debts, etc., like a bad loan. We started with early versus late payment. It's a model which feeds in a downstream model for our default prediction, because default is the one who will at the end impact your revenue and your charge-offs. We also had repurchasing information because you can revolve your loan. Something changed on the market, you maybe change the either line of the business, etc., and you need to pause your loan. You will negotiate with the bank, or you need to buy a different loan to repurchase this one, etc., because you may find it in a different bank with a better loan rates, etc. So this is why we needed a reason as well. It's not relevant to revenue, but it is relevant to give you some of the information. Do you want to keep this customer or not? So it's like a branching. After defaulting prediction, you have more than enough information to start a revenue prediction. So now you have all the building blocks. So I'll cover a bit of each of them. Bankruptcy was built as a standalone, but it also has a time series component if you want to find when it's a bankrupt, when bankruptcy could tend to happen, so that you know how and when to sell this loan. But from the other side, if you have also defaulting prediction, defaulting will happen prior bankruptcy, because you already started to change your behavior before you came to the state where you can't cover your loans. And we started to add some additional information like birth dates, when, where, how, what you are working, a lot of different demographic information to put it in a system. Also for every loan, how mature is it a loan, how many payments did you do already, etc. It's constantly recalculating. And based on this one, we found out that the classical approaches with GBMs or random forest work really well and have really high output and correct results. A little bit trivia for others who will do the presentation, what they are doing essentially with the GBM. Every loose metric, we try to boost it in the next iteration so that it gets better results, so that we are not focusing constantly on the top 3 or 5, but try to find correlation even with least important features. And similar, random forest is a bunch of the forests. Both of those are important for end client who is not tech savvy, because both of them show them how the people reason as well, and what is your path to reach some of the conclusion. This is the reason why we opted for it. And we try to use the same set of algorithms across each of the models, because then client knows what we deployed and how to explain results, what they are getting. On some of them, we didn't succeed so much, so we needed to approach a little bit different. But let's go back to our bankruptcy part. When we started to do this one, we used essentially area under the curve as a metric to evaluate how precise our model are. And what we got essentially at the end is really high percentage. And this percentage was led by that white labeling or white list, because in US you have that American dream, and they are inclined to go 3 to 5 more in depth than European side. So the same model will not behave the same in Europe like it will behave in the US. It's not strange that they will go in bankruptcy. They will go and get their own stabilization period after it, etc. Self-bankruptcy as a people. We know that even the US president bankrupt multiple times. So it's not strange to see this in US, and it's not even something which somebody takes against you if you bankrupt. From the other side, if you come in our region, if somebody bankrupt, nobody will work with you. So this this is the reason why they go so much over in depth, that they can try and get their American dream up and living, and this is why they are so much in overdraft, and those whitelists show you really good tendency how risky as a customer you are. So if you see here, maybe this will be even better. I'll show a little bit more information. Go back. The model, two of them, essentially from 95 to 98% precision of predicting will you be bankrupt or not. Just the most information, if we go back, are related of how much you are exposed through other channels. We don't know what they are, but two of the information are important. How many of them? Not even amount. How many and how many different types? So am I exposed through the credit cards? I have different loans for a car, for householding, for AC, for house or whatever. So bunch of them just show you number of those derivatives on a loan market. Just two of those information are high enough to skyrocket a precision for a bankruptcy. In both cases are one of the dominants. You still have some assessment done by government, like a FICO score, but we try to push them down because this is also something we try to predict, not assign a FICO score which is already done by government instead of you. Now, this is what I showed already. Overall precision of the model was really good, and it was used now as part of the risk scoring algorithm. Then we started with the early versus late payment, that you detect drift in the payments, how much they impact. Sometimes even early payment is a show that something strange is happening, and you need to have it in environment before you start applying a downstream logic. And we categorize those either for every loan element in or payment schedule in a loan, you have a due date when it comes. And we categorize the early versus late is one is a 7 day, up to 7 and more days prior due date and 7 and more days after due date. Everything 7 days prior up to 7 days after is calculated as a normal payment schedule because it can slip if it goes in the weekends or whatever, how it goes and transfers between the banks. So you calculate those as a normal payments. And this was also used to feed downstream algorithms. Initially, it didn't show really good element until we started to add a little bit more information, but it has really good accuracy, at least to categorize the data, how and what you are behaving. Later on, this information was mostly used to add a different loans. So for a cross-selling, upselling models, not so much for a revenue calculation. In this slide, what I wanted to show you is two of the information which are really important is how many payments did you make till this point? So, and how stable essentially you are, not even, how many payments and what was your original one of the fees, because every loan has up to 4 different group of fees. How much it costs to acquire that one, source the customer, how much you have origination fees, etc., etc. All of those bundle to up to your total amount of the loan. And essentially 3 big is it working? No, it's not working on the screen. So 3 important information were dominant here. Number of the payments, one of the fees, and what is your monthly income. And those 3 information tended to show how likely will you be to drift in a payment schedule. All the banks like payment to be on spot, not even early, because then they need to reserve it differently. It's always better when they comes on a term, on a clock. So if you say it will be first in the month, it needs to be first in month, or otherwise something else will drift. They will not have the same amount on their account to do different loans, etc. Even if it's a virtual money, it still needs to be accounted and registered with the risk scoring on a government level. And one additional information which at the end came as a dominant, it's a state. And this came in 2019 as a dominant information when in the US, because some of the states started to shift and close different industries. And this became really important because if you are closing a specific industry within a specific state, you know that it will be a lot of defaulting. It will be a lot of changes in behavior because people are laid off, etc. And there will be something in the market and you need to react before it comes to the point when you are not getting your money back. Similar approach when we did it with random forest here. Instead of one of the acquisition fees, original charge. So you have those, a bunch of the fees coming into a loan calculation, but the charge, in this case, original charge, which is paid when you are acquiring a new loan, is one of the dominant together with how old is your loan. So both of them took a little bit different information to get to a similar conclusion, and then we used an ensemble on top of it to get the final result. As you see here, not precise as a bankruptcy, but it gives you a really good tendency to show where and how your behavior is drifting. Repurchasing reason, it's not so much important for a revenue, but it's important for your decision making. What do you want to do with something which is potentially a bad debt? Do you want to sell it to a different bank? Do you want to offer a different line of credit so that they can repurchase this one, etc., etc.? It's for your reactive activity, essentially, what do you want as a bank to do on top of it? And unfortunately, one of the biggest information here for reasoning is your FICO score, because that's also what we needed to exclude at that step, because FICO score is the one leading to calculation. And then number of different public records. Number of different public records mean number of different loan type of services you already did through the whitelist. Was really important to see what is your reason to start in a repurchasing approach of your credit. Okay, a different approach. Again, see, in this one it's just discount, but again, FICO score, we needed completely to remove it. It's a government-based score, and it is really good value, but it's already after the fact, and we needed to mark it as off. And what we did try, you see, if I go back, when we started with the process, multiple layers of the training, it started with the precision like from 60-something% up to, it's not this one, the previous one, from 60% to like 78% of precision. And when we started doing multiple runs and training and seeing different patterns and trying to boost all of those outliers, etc., and try to remove some information like a FICO score, we started to get a little bit better results. So from 70% up to 92% of precision of calculating what is your reason. Again, this is not something we used for a revenue, but it is used for decision making down the stream. And now the most important part was when we have all of those building blocks, how we can now start piling this into defaulting prediction. And for defaulting prediction, we went into two different directions. One direction is a classical binary, yes and no, do I want to default? And this is a time-based component when, essentially, your life cycle expectancy, when you will start with the defaulting. And the other will be a multi-variant or multi-class prediction. In this case, we said we want to find a pure cut in point in time when your behavior is so drastic that you will start defaulting or you will not essentially return any new payment. Based on that, we started to apply, again, model and to find a different elements. When you have irregular payments, so this we first classified, do you have irregular payments normally? And then it's a different logic. If you have a regular payments and then you started to behave irregular, then you will get a little bit different calculation. And also we started with the different classes. So what is your reason which led to defaulting? So maybe you did only the first payment and then you stopped. Or you did one payment, you don't care. After 3 months you paid the first one, it still didn't kick off a government state level defaulting. So that was different. Multi-pay, you paid 5 of them of 60 and then you stopped paying. But you still, from the government perspective, need to calculate like 90 days, which is like 3 months, additional revenue. And this is something people do tend to forget that they will be liable, even in that case. And we started to see what we are getting. Again, results are so terrible. At this point, I think that we were 70 to 76% of the precision default, when defaulting will happen. That's the model. But this is, for a customer, this was really good because they saw what is the reason. But we needed to approach a little bit this with a black box now approach. Unfortunately, it needed to be a black box during 2018 and 19, new shifts on the market started to happen, especially in the defaulting prediction, by applying AI on top of it. They started with SVMs, LSTMs, with RNNs, but the most interesting for us was artificial neural networks, with some concepts of boosting and information in background, not just boosting, but trying to do some logarithmic scales so that it's not pure classification to get results out. And this is what we went. We started with ANN and we started with survival analysis. When something will happen, and that when will become a function how we trigger AI inside of it to calculate appropriate elements. This will still return point in time when we expect specific loan to default. When you find a specific point in time when something is defaulting, then you again kick off expert system which will do the proper calculation. So this only finds a specific point in time, not a monetary value. It finds a likelihood that 3 months from now, or 18 months from now, or 24 months from now, you will default. And it is evaluated on every month based on whatever you are doing. So this is what we started. We started with bootstrapping elements, and there is one method here which is mostly used. It's a logit, but what we use, we try to skew it a little bit and use this as activation function. And it became a really good result, but it's not good, it's black box. You can't explain it to customer. You can say, okay, numbers are correct. How can I trust you? Don't do anything. If it happens, you'll see that they are correct. Unfortunately, none from the business likes it, so we needed to do something else on top of it just to try to explain it. But still, this gave a little bit better results. Still, it had a lot of drawback. We uplifted about 10% over the traditional methods, but it had a lot of computing power related and time to build initial set. So we'll need to do a little bit more tuning going forward, but this provided now good enough information, like 86% of precision, when something will happen in the future. And I'll show you on a few of graphs how it happened, where we used the model from 2019 to show the value of what is happening now with 2020, 2021, like 2 years in the future, how it reacts and how every new iteration of the data self-learn and corrects the model at least a little bit. So at the moment, this one is in production, and what we approach example which started to group all of it. So we said that we build all of those models. They are built just to be input in revenue prediction. Now we have all the building blocks. We can now start doing a revenue prediction. For revenue prediction in normal industry, which are not banking, it's a time series problem. In this one, it's combination of government, state regulation, and whatever happens with your behavior as a client, as a industry, as I don't know, regional. All of those have some impacts on top of it. And we started to predict what will happen in 1, 2, 3, 6, 12 months, 24 months, 48, etc., but on a loan level, not on aggregated. So all the results gets aggregated so that they can react on top of it. But if they need to do a proper analysis, they have everything on a monthly basis done on every loan separately so that they can do operational alignment on top of it. And from the workflow perspective, it's quite easy. The client calls with incoming data, coordinator kicks in, do the expert system. We talked about expert system doing those payment schedules. Expert system will then kick off appropriate models. Models will again kick off expert system depending on the base, because one of the model will also predict through the revenue prediction how many of the new loans I'll have next year. And your model will spill out like 10 of them for this specific product. Amount of those loans is X, Y, Z. Then you need to feed this back to your expert system to again recalculate payment schedule for them before it start looking how many of those newly predicted loans will default at some specific point in time. So it is a little bit looping. This is why we went with more microservice type of architecture. That model is calling model, and they have a little bit of unstructured interfaces for talking. So it's one calling another with a JSON type of the structure that they can exchange the data and call it itself multiple times before they spill the results back. And results back come in twofold. One is a proper database dump where they have every loan separately on a monthly basis recalculated, and the other is aggregated information that they can react on top of it. And I'll show just two of them. One is when we went through predicting when something defaulting will happen. So you'll see the blue line, and this does not work. The blue line is what really happened. The red line is what we predicted, and those round lines are nothing more than a high and low value, so that they have some bandwidth if they want to tweak something. Because this is an input into their other algorithms, how they do their own risk scoring, so that they have a bandwidth where it goes, and how the model does. So you'll see that this one ended in August 2020, using model from the January 2019. How little drifts we have, but a lot of changes in behavior, just because of ANN model and trying to use it as skewed log-end mechanism. From the other side, financial charge, because this is a much bigger volume. So this is a charge of essentially when you are already defaulting, what is the money we are throwing out. This is why we see it so wide. Not a lot of them. But when you have a high volume of financial charges on a monthly basis, they're almost on top of it. And this is starting like few millions. It's not a big difference from the upper and the lower base. So it does not have that wide gap between low and high. It averages up across all the products. And I think that's it. Any questions? Or this will end it. Yeah?
Thank you for your presentation. There is some difference in calculation of contraction and extension risk of prepayment or postpayment.
Yep.
And that's first question. And second question, does this methodology can applied on some credit derivatives or some fixed income products in market?
Okay, first, based on early payment versus late payment, yes, definitely it has an impact. Even early payment shows a drift, but not so significant like a late payments. Early payments, if they happen across a little bit longer period, tend to show that you want to repurchase your credit earlier. So it's used for a different calculation. But for us, for a revenue side of the story, they are both bad behavior, because we wanted to have a spot-on time. So when you are doing a revenue calculation, you want to have a revenue for a specific month going on a specific point in time, and then do your reserve calculation based on it. So from the perspective of how likely is that they will default, more late payment is important, but for how much, or do they want to, or do they plan to repurchase the credit, early payment tends to be a really good indicator, especially if it starts to happen earlier, and you'll see sometimes even 2 or 3 of them happening. And this piles up to the point, every loan has a breaking point. If you pay it on the breaking point, it means that you saved a lot of money. If you go after that breaking point, you pay more in interest or conversion of the loans, or even if you go prior to that breaking point, you may pay more on interest itself, depending on what type of loan schedule you have on your side. So this is more important of behavior of the customer. Do you want to keep it or not, early versus late, which would be for your defaulting behavior. And the other question is, can we use it for something else? Well, this is heavily focused on banking just because of the data set. But any type of derivatives which is focusing on your credit exposure can use this data. So US is a really good example because it has whitelist. Whitelist shows you the whole, let's say, breadth of depth you as a person have and how risky you as a customer become. So any type of derivative can then go from it, whatever you do, overdrafts or whatever.
Okay, thank you.
Nobody else? I see, and I hear crickets. Nobody? Okay, then thank you.
Tomislav, thank you once again. Such a pleasure to have you throughout the years, and thank you for your support for Data Science Conference.
Thank you.
Welcome.